Hello, thank you for joining us today. I'm Joyce Klein with the Aspen Institute Business Ownership Initiative, and I'm delighted to be here for our session today on the decision dilemma, tools to navigate small business lending program participation. I'm joined today by my two co-panelists, Sherry Flanagan-Vasquez from Justine Peterson and Brett Simmons from ScaleLink. Just a little bit about the Business Ownership Initiative, or BOI, if you don't know us. We've been working for about 30 years in the microenterprise or microfinance sector in the US. And in our work, we've had a long-standing focus on working with CDFIs that want to scale their microlending. Justine Peterson is one of our longtime partners. We've been working with Sherry and team for a long time. We've collaborated on a number of different projects. They're also a member of our Microfinance Impact Collaborative, which is a group of 6 of the largest CDFI microlenders that we've been convening and collaborating with for a decade or more. And Brett, who's with us today, is the CEO of ScaleLink. ScaleLink is a new CDFI that's building a secondary market for CDFI-originated microloans. ScaleLink's approach was developed by a team at Axion Chicago, which is now Allies for Community Business. And BOI and the Microfinance Impact Collaborative members work with the team that created that approach at Axion Chicago to design and launch ScaleLink, which is really a solution to the capital and revenue challenges that CDFIs face in scaling their microlending. So to give you a sense of what we're planning for session today, here's our agenda. I'm going to do a brief setup to the work that we're doing and how it's led to the development of the tools we're going to share today. And then Brett and Sherry are going to walk us through some scenarios for lending programs that demonstrate the application and hopefully the value of the tools that we're going to be sharing today. And Brett's going to walk through how to apply those tools. And then if we have time before we go into the live Q&A session, I'm going to ask Sherry a few questions about how she would think about the use of these tools in her role as the COO of a CDFI that does small business lending. And if we don't have time, we'll go straight to Q&A and maybe we can get to some of those questions then. So great. Thanks, Brett. The development and the eventual dissemination of the tools that we're going to share today is part of work that BOI and ScaleLink are doing as part of the Initiative for Inclusive Entrepreneurship, or IIE. And in case you haven't heard about it, IIE is a collaboration between the U.S. Treasury Department and philanthropy to help ensure that state small business credit initiative dollars reach underserved entrepreneurs and particularly reach business owners of color. If you don't know that much about SSBCI, it's providing $10 billion over 10 years to states to help them create programs to support small business financing. And it's a bit different from the original version of SSBCI, which was created during the Obama administration in response to the Great Recession. And the difference is it's more money, $10 billion, and it also has a much more explicit focus on reaching underserved entrepreneurs. And the philanthropic partners that have come in with Treasury have committed up to $100 million to help reach that goal. So a little bit of background about IIE. It's led by a group called Hyphen, which is incubating the initiative. And there are a bunch of partners, and actually, Brad, I'm still on the last slide, which specialize in different kinds of small business lending needs. So there's a vertical that's on reaching supplier firms that need capital. There's a group on high growth firms. There's a team that's working on Main Street, financing for Main Street businesses. And there's a group that's working on tribal businesses. And the real focus is on both building sort of products and supply capacity to deliver that financing, and then also engaging with state administrators who run the SSBCI programs. The initiative was launched in January 2023, but BOI and ScaleLink were just brought on in January, and we have a specific charge that's focused on how do we help stimulate the use of SSBCI to support lending in the amount, CDFI lending in amounts of $100,000 or less. So, okay, now I'm on to the next slide. When the IIE came to us and asked them to work with them, they asked us specifically to work with a cohort of high volume CDFI microlenders and to focus on 9 states that are key to the initiative for inclusive entrepreneurship. And there was really good overlap between their focus that they wanted us to take and our Microfinance Impact Collaborative. And the members of our Microfinance Impact Collaborative were really interested in tapping SSBCI, but weren't always finding it successful or finding it hard to do that. So we were really interested to dive into this work. What we told folks when they invited into this project was that when you're talking about getting more lending in amounts less than $100,000, the issue wasn't really that there weren't established products being offered by CDFIs. There are lots of folks that are doing CDFIs that are doing lending in that size. It wasn't like there were CDFIs that weren't capable of originating those loans. We said, the issue is really twofold. The first is that the programs that states were creating under SSBCI didn't really align well in some cases with the financial and operational needs of CDFIs that wanted to use the programs, particularly if they wanted to lend at higher volumes as part of those programs. And the second thing we said is that CDFI small business lenders right now are being asked to take on lots of new kinds of programs. And typically each of those programs really has sort of a set of significant operational, strategic, and financial implications. And actually, it takes a lot of sort of bandwidth just to assess the options and decide which ones make sense. So those are the two issues that we are really focusing on as part of our work with the initiative. And that's described on the right side of this slide. So one of the things we're doing is working with our collaborative members to identify how we can sort of change or adapt the design of SSBCI programs so they really fit with their needs as lenders and lenders doing smaller dollar loans. And ideally, not only help them to sort of originate those loans at some level of volume within those programs, but also ideally support their long-term sustainability, maybe leaving assets on their balance sheet at the end of the 10-year program. And the second thing we were going to do, and that's what we're talking about today, is create tools to help CDFIs navigate choices about which programs to take on. So that's our focus today. But if you're interested in what we're doing on the program design phase of this work or part of this work, please stay tuned and we'll be sharing more later this spring on that as well. So in terms of the tools we were developing, we and Brett in particular, actually, we're working on developing these tools before IIE even came along. And the reason for that was, and this may be familiar to many of you who are CDFIs, but what we were learning as we were meeting and working with our collaborative members as they sort of came through and out of the pandemic, was that they were being approached to participate in a lot of new programs, new lending programs. And in a way, they were sort of a shift, at least in terms of emphasis, between funders saying, we're going to give you money to support like your core lending, and more of a focus on, we've designed a program that we want you to be part of and we want you to execute against. And just to give you some examples, there were a lot of programs that were developed during the pandemic. Some of those were philanthropic programs. Some of those were federal, state, even local programs that were created. There were philanthropic initiatives around racial equity. There was some changes to Community Advantage and a call for small business lenders to do more sort of Community Advantage, now 7A lending. And obviously there's SSBCI, and there are a number of different programs that states may offer as part of SSBCI. And as we were talking with CDFIs about how they were thinking about these programs, we heard they had a sort of a common set of questions or issues that came up. Sometimes as they were deciding whether to participate, sometimes they found out later on after they've been doing the program that there were some sort of real issues. And some of those were questions like, how does this program actually affect my lending relative to my target market, which is obviously a critical issue for them. In some cases, the programs that they were being asked to step into didn't really cover their costs fully of originating under the program. Should I still do this because maybe there's a target market reason, or maybe I feel like I can't say no to this funder? How much capacity is it going to take for me to execute on this program if it's different than my core lending? And do I have the bandwidth to do multiple programs from like a capacity perspective? Sometimes when CDFI stepped in, it wasn't the question of whether I'm going to do this program, but how much of it should I do relative to my core lending or other options? And then in some cases, there was this question of like, do I have the capacity to sort of shape this program? So maybe it actually fits better with what I'm trying to do from a scale and an impact and a capacity question. So what we've tried to do in creating these tools and what Brett is really sort of create a process and an analytic tool that can help CDFIs navigate those choices. We actually hope they may be helpful as you maybe negotiate with funders around program design and program support. And while we've developed these tools mostly for CDFIs, we actually also hope that funders take note of the issues that these tools captured, so that if you may be thinking about as a funder, I want to, create or support a program that maybe creates a certain outcome that I want to see. How can you think about also designing the program so that it also addresses critical issues of capacity and the long-term financial health and the sustainabilities of the CDFIs that you're wanting to engage in the program? So with that, I'm going to turn it over to Brett to focus really and share about these tools and to Sherry as well.
I'm looking at a tech support question that I don't know how to answer, but hopefully I can address it at some point. Okay, so today we thought we would start with sort of the baseline that you need to know before you assess a program. So we've got some scenarios that we're going to walk through, but these are the basic questions that the scenarios answer, which if someone's proposing a program to you, we would say, this is what you need to be asking and understand before you can use the tool that we're walking through. So the first is the loan product, who's eligible, what's the underwriting, how the customers will get to you, and how can you process the loans through the program, who the customers are likely to be and what the geographic constraints might be, who's funding it and what costs are they covering. And this is not just what costs they're covering for you, but what costs are they covering for the program. And that's really important when it comes to your long-term philanthropic efforts. If the funder is covering the cost of something else that you're participating in, how does that influence your future fundraising potential? And then what the administrative and compliance burden might be. So to get started, we're saying you should have a rough view of these things. Today, we're going to use the example scenarios as a way to try to express the theory behind it. We obviously have spent a bunch of time on this and written a paper that we're going to publish, but we thought rather than presenting theory at you about how this should all fit together, we would actually walk through real-time examples and have you participate in the process. So I am showing my screen in presenting, but I am also in the chat right now. So I'm going to use the chat live to get your feedback on the scenarios as we go. So if there's a participant right now that wants to put something in the chat, just so I know it's working, that would also be helpful, as I can only see that Brittany has put something in there now. But the chat is going to be a way for you to express what you think the outcome is in the presentation. And I will try to address what your thoughts are before I show you how we are thinking about it. And then at the very end of this, we haven't published this paper yet, and we have a draft that we're working through. So if you have a program or approach that you're doing right now and you are interested to apply the tool, we're actually looking for some people to give it another test run. So you'll be able to follow up with us afterwards if you're interested in doing that. Okay, so we have Sherry here, and she is part of Justine Peterson, as mentioned. I just wanted to give you some stats on Justine Peterson so you understand what type of perspective Sherry brings to the table. So they're in 3 different states, which always presents different challenges as you move outside of one state and have to deal with the laws and approaches and policy staff of a different state. They've done more than $230 million of lending to 13,000 small businesses. And I think importantly, have really high CDFI target market and percentage of entrepreneurs of color served across those 13,000 businesses. And then finally, they have 40 plus investors to manage, which, as many of you know, the more investors you have, the more compliance you have, the more schedules you have to deal with. Program design is not so different than managing all those investors. Sherry, is there anything else I should mention here?
Yeah, the one that I noticed that we didn't put on the slide is Justine Peterson does have a client base that really starts with a credit score of around 575. So really entry level entrepreneurs that are really have some personal credit building to do as they're building their business.
That's great. Thanks, Sherry. Which I think is, based on the 50 or so CDFIs that I've reviewed, that's definitely on the lower end of what the average is for most CDFIs doing small business lending. Okay, so I'm going to walk through the scenario. I'm actually going to read it. I know that you can read, but by reading it, you will also have time to go through it on your own. So I'm going to take a minute to do that, and then Sherry, we're going to get her response and just some initial feedback on the design itself. And these are all examples. These are not real programs. So I put Ohio in here. I have nothing against Ohio in terms of this program design. No one from Ohio gave me feedback on this. It was just a random choice. Okay, so your CDFI does small business lending in the state of Ohio and has been for 15 years with a good track record. The state is offering an opportunity to join a capital access program where you'll be able to enroll loans in the program, and the state will match your cash contribution to a loan loss reserve account dollar for dollar up to 4%, enabling an 8% cash reserve. You will own half of the account but have access to the full amount in the event of a loss. You can use your traditional loan product, but will have to hit some underwriting minimums to enroll. In particular, the partner agency has decided that each loan enrolled must be underwritten again by the agency before approval, adding time and some uncertainty to your access to the loan loss reserve match dollars. They have provided some basic guidelines for what they will approve, but reserve the right to make the decision in all cases. Additionally, there are some administrative burdens to consider. There are 10 variables about the borrower that you don't currently ask about, and 3 that will require follow-up 3 months after origination. If you join, the state will add your lender to their website and plans to advertise the program. You do not have to enroll the loan in the program, even if it comes through the state marketing campaign. Sherry, are there, 1 or 2 things that just stand out to you in terms of the challenges or upside of this scenario?
Sure. So the is the loan loss reserve, and there's often a fundraising burden of raising that cash loan loss reserve. So that is a benefit. I do have quite a few concerns with how this program is laid out. First, if I was exploring this program, I'd want to know exactly what your existing writing requirements are, because you'd want to avoid with your client population. You don't want to put your best borrowers into this program. Though the largest red flag is the loans being re-underwritten by the funder. And we have fallen into programs where the funder is re-underwriting, and it's very frustrating and it's very time consuming. So I would try to avoid the re-underwriting unless they have clear guidelines of what they'll approve and what they won't approve. Now, the administrative burden is definitely something to consider, especially that post-closing follow-up if you're not already doing months, making sure you're clear about who's going to do that on your team and to make sure it gets done, but that is an added cost and any administrative overhead. And then the last concern I would have is on the marketing. While client acquisition is often seen as a benefit, if you are receiving a lot of referrals through this program, you will have to handle that volume unless you already have the staff capacity to take new intakes. And then I'd be concerned with it being on the state marketing campaign, how that will align with your target market. You wouldn't, are the clients coming through that marketing campaign similar to your existing client base?
That's great. So that's some initial feedback from Sherry. We're going to apply the tool, and I think it'll, further highlight some of those concerns that she mentioned as well. So we're going to do one other scenario, and I want to lay this one out. But first, I just want to walk through some of the basic economics of taking a small business portfolio and what it looks like over time. So I've just put $1 million portfolio here with an average loan size of $40,000 and the interest rate and term remaining that you see on the left, along with a cost of funds of 4%, given what types of rates people are being quoted right now. I put in a loss rate around 8%, which I think, is probably on the upper end of what people see. And I just want to point out this is cumulative. So it's not a net annual loss rate. This is take the $1 million portfolio, wait the entire 48 months and see what the write-off rate is. I think most CDFIs see between 6 and 8%. If you put all these variables together in the outcome comparison on the right, you'll see in the hold scenario, that $1 million becomes $1,074,000. But at a 4% cost of funds, most of that income is totally eaten up, leaving a net cash position of $998,000. This is ultimately the challenge of a lot of programs is once you factor in all the variables behind the costs, even without taking into consideration your cost to underwrite the loan, you end up in a negative position. So program design really has to take this into account. And the next program that I want to show you does address it at least somewhat. So scenario 2, you manage a multi-state CDFI doing lending in 3 states. One of your funders would like to help you grow in Iowa through a new program. That program requires a credit score minimum of 650 and requires demonstrated 1.15 debt service coverage over the previous 2 years of tax returns. But for underwriting loans in the program will pay you 102% of par for a 90% share in each loan. So what that means is 10,000 times your 90% share times 102%, which would be your 9,180. You're also allowed to finance the fees into the total amount financed, so you get that 102% on top of fees. You retain 10% share, and you also receive $20 per loan per month for servicing, and you have to transmit payments each month to the program. The funder here is also covering a marketing campaign to encourage borrowers to apply. The applications are not going to be screened in any way. So all applicants, you get 25% of them. You have to review whether they're creditworthy or not. Sherry, initial thoughts on this one?
So in this program, the financials are really attractive. However, you only get paid on the loans you actually originate. So that would be a concern. The other concern financially is, since this is an existing fund, will the funder be funding this program in addition to what they're already funding at your organization? Sometimes when funders come in with new fund, though, make sure the funder is going to fund both of the programs. Us, as I mentioned, we have an average credit score of 575 at intake, and this one is a 650 minimum credit score. So if we were getting our same target population coming in to apply, we'd be denying about 70% of applicants, which, our lenders hate to deny applicants. So I'd hate to run this program in isolation of any other program. So for us, this would really only make sense if we were going to Iowa and give our credit building program and small dollar that we help those. Also, the concern is the marketing again, especially credit score requirement. Would the borrowers that come in fit our target market? And how are we going to support the intake of borrowers that don't qualify program?
Thanks, Sherry. Hopefully, I know there's a little video lag with Sherry's, but hopefully you caught what she was saying. But we're going to walk through these scenarios now. So what I've done in each of these next scenarios is, this is just a recap, same thing of capital access program. This narrative is really small on the screen. I know it's hard to see, but I wanted to have it up there just in case you wanted to check facts as we go. And at this point is when I'm going to turn to you at some points to ask about what you think. So I'm reverting back to the capital access program. This is a program where there's the match loan loss reserve account, but you're able to use your same traditional loan product. So the basic approach is, do you think that this new program is going to reduce revenue versus existing products or be similar to your existing products? So far left, reduce revenue versus existing, middle is same revenue, to the right is better revenue. I give about 20 seconds if anyone has input to add in the chat. no one puts input, then I won't know what you're thinking. All right. The answer on this one, from our perspective, is that it's going to be the same revenue versus existing products. Moving from revenue to the other side, costs. In this case, there's a loan loss reserve. So we have on the top similar acquisition and loan loss reserve expenses. In the middle generates marginal acquisition and loan loss reserve reduction. And then the final is generates significant acquisition and loan loss reserve reductions. In this case, because there's a loan loss reserve match, but there's some additional acquisition costs potentially, and getting the customers and being advertised and having to go through the additional underwriting. We characterize this as generating marginal acquisition and loan loss reserve reduction. So this is how we put things together. This is the cost and revenue table, and you can see those two choices put us right in the middle of these 9 scenarios. And we said that this is what we would call a yellow scenario. So it's on the fence of the total economic impact. In this case, we said check for cannibalization. And cannibalization here is really if you introduce a loan product through a program that actually competes with your existing products, then you might lose customers from your existing product to the new program. So, it can be, ultimately a revenue reduction if customers are leaving a product that's better for your bottom line and going to this program's product. In this case, because you get to choose whether the program goes in or not, that allows you to avoid some of the cannibalization challenges. So after we look at revenue and costs, we switch to mission outcomes. So first is, in this case, is this going to reduce the percent of your loans to your target market, no change in target market percent, or increase percent of loans to the target market? And we focus on the target market percent because that's what CDFI certification was driven by. In this case, it's this existing loan product, but there's a lot of underwriting challenges in terms of how they're enrolled that might make it difficult to enroll all your products in it. And so given that you're going to put focus on this and it's going to take some administrative support to do that, we characterize this as potentially reducing the percent of loans to target market. In terms of subsidy, we then look at who's funding this and what are they covering. So the first is it the same funder that you use right now? So just as an example, let's say you had funding from Wells Fargo or another regional bank, and they're the ones sponsoring the program. That would be using the same funder base, and that's something you should take into consideration. The second is using a new source of subsidy. So in this case, it could be a state that's inviting you to a new program, and it's a totally different funding source than you've had in the past. Or there's the unicorn situation where you have a program that doesn't need subsidy. Doesn't happen often, but it's built into the model in case it does happen. So we characterize this as using a new source of subsidy. So you're moving into a state you haven't been in before, working with state dollars in order to do the program. So out of the 9 scenarios, places us on the left side. And again, we put this as a yellow situation, and it really comes down to the sustainability of the funding. So if you're going to take on a program with new sources of subsidy, is it sustainable over time? If it's reducing your percent of loans to your target market, you might still want to do the program given that there's new funding available and helping you grow your business overall. But it's a trade-off. So if you do this program and not another, you're using organizational bandwidth to do that. And what's the implication of joining it, especially when it's reducing your target market percentage? So something would need to offset that. Okay, so then we have these 2 tables. That's how the tool is built. The tool has all 81 scenarios between the 2 tables included. So you can go from, we put it into these buckets. This is how we think things are going to play out. And then look at how we would characterize what choices you need to make and what additional analysis needs to happen. So in this case, this is the write-up directly from the tool on this type of combination. So we think that, there's benefits from the loan loss reserve, but to really solve for a better outcome, there needs to be a process for dealing with clients that don't qualify. So you put someone through the program, you want to get the loan loss reserve match, they don't qualify, but you've got this, all these additional leads, but you're in a new state. How do you manage these turn downs? So it's super important to think through what the group of turn downs look like from the state and whether there's a way for you to be able to work with those customers. So it's really testing, why are they being turned down? Are they part of our target market? Could we serve them? And there's really an opportunity here to find funding to manage the turn downs. And given that the turn downs are likely part of your target market, since the program is potentially taking on the higher credit worthiness customers, there should be potential mission overlap and good probability of being able to fundraise some. So again, that's how the tool plays out and gives combinations for each type of scenario. Okay. Next, we're going to do the other program. So this is the program where you're getting paid 102% for a 90% share in each loan with fees financed in. In this case, we said that the program, given how difficult it is to do this lending in an economical way, and there's 102% pricing, that it would actually be better revenue than existing products. As I go through these each time, if you do have a thought and want to put it in terms of what you're thinking about the programs, I am looking at the chat again for any feedback there that I could address as we go as well. So the better revenue than existing products. In terms of acquisition and loan loss reserve expense, there's advertising. You're going to get a lot of leads through that, and you're able to cover some of your loan loss reserve costs by actually, moving things off your balance sheet. So you're taking a loan that's on your balance sheet, moving 90% onto someone else's. They're going to take losses if it's a true sale. So you're going to have that loan loss reserve reduction. The marketing campaign would potentially be helpful, but as Sherry pointed out, because the applications aren't screened, if you get a lot of applicant volume, you're going to need to devote significant resources to it, which is why we put this in the marginal bucket rather than in a significant acquisition benefit. Okay, so that, in the 9 scenarios puts us on the right side, which is a green outcome in our view. So you've got better revenue happening, marginal acquisition, loan loss reserve reduction. There's obviously things you would potentially want differently, but from a cost perspective, given all the applicants you might see, but overall, it seems like a good program. From there, we turn to mission outcomes. So same table as before. What impact would it have on your target market percent? So Sherry pointed out the credit score minimum here of 650 might cut out a fair number of customers. She estimated 60 to 70% of their customers would automatically not qualify given that credit score minimum. The debt service coverage over 2 years of tax returns tends to, mean you're going to work with more established businesses as well, which in many cases don't fit people's target markets quite as well. So it's a bit of a red flag from our perspective. The second piece is, does this use the same source of subsidy? The answer here is yes, pretty straightforward. It's at the top. It's the funder that you've been working with. They're inviting you to participate. That raises its own concerns about how to approach this program and the design of it. So out of the 9 scenarios, we're in the top left, and we characterize that as a red scenario in the tool. So how do we put these two things together? We've got green on the cost and revenue table, but on the mission outcomes and subsidy side, it's a red flag. So this is an interesting one because of the common funder. If the common funder has been funding you, they likely support how you aid your target market. And your target market numbers must be in line because you are a CDFI. In this program, the target market numbers go down because of how the program's designed. So we would say it's poorly designed in terms of credit box and outreach for the target market, potentially making your mission outcomes worse. So given it's a common funder, the tool is set up to help you then go back to the funder to say, look, this is how we're interpreting the program and why. This is why we think the target market is not going to be served the way it should be. We think if it's a common funder, it's a good opportunity to talk through with them how to design it differently. The alternative here is that maybe a program's just not necessary. Right? If you're a high volume lender in 3 states already, It could be that the funder, rather than setting up a program for multiple CDFIs, could fund the CDFIs directly and just allow them to expand their target market work without a program, which I think, given sort of the proliferation of programs in some cases, the thought to just revert back to funding your expansion sometimes gets missed. So it's important to be able to make that connection and push the funder to consider alternatives as well. Just in terms of how this all fits together with the red, yellow, green in the tool itself, the theory side of it, we walk through why we think each scenario, those combinations are red, yellow, and green. Today, I have those in there just to visually help walk through things more quickly, but we very intentionally leave them out. So like they're not here. And in the tool itself, in the first pass through things, the color coding's meant to not be used to not over influence how you end up categorizing things. Okay, so let's say you've gone through this tool. You've decided that maybe the program's yellow and yellow or red and green, and you have a sense of what you might need to do. The tool then comes with a financial analysis input. So at the bottom there, you can see all the fields that you can put in, what your current state core assumptions are, assumptions for the comparison program, and then some approaches to how to deal with some types of cost or revenue that you might not have a good sense of what the unit costs are, but how to put in assumptions and test different outcomes. And ultimately, we think any program you're doing, this is the next step, is you have to have a strategic view on whether it fits with how you're approaching program design and your mission impact. But then ultimately, you need to do the more detailed financial analysis to understand how you can approach it. So that's part of the tool as well. I'm not going to get into that for each of the programs today. The final piece here, and this is something that Sherry and the MIC group that we worked with that Joyce mentioned have brought up, is, and maybe this is something we just need to consider in the next iteration of this, is it's really hard if someone brings you a program to think about the customer's experience of the program and your staff experience of the program. I think both are really important when you're thinking about the long-term benefit of engaging in it, whether you're getting stretched too far or your customers are experiencing you first through another program rather than directly, and what that means. So that's part of the final discussion in the tool, but is a little harder to capture in the matrices. So we wanted to point that out as well. So at this point, I think we're at a stage where we could switch over to the Q&A, Brittany. I know we're a couple minutes early, but it'd be good to head over there and be able to address people's questions directly. Okay, so we are going to exit out of this and click into the Q&A now, and we will see you there in just a minute.